There's been a lot of recession warnings from an inverted yield curve. What does that even mean? In this video, we're going to talk about what an inverted yield curve is, why it happens, and why over the last several decades you often have this inverted yield curve happen before a recession. What does this all mean? If this is your first time tuning in, you're watching Unrivaled Investing. My name is Daniel. Let's dive right into this, where first of all, the headlines. 2-year Treasury yield tops 10-year rate, a yield curve inversion that could signal a recession. Another example with Bloomberg talking about bond market flashes recession signal as key yield gap inverts. So in order to understand what an inversion is, first we have to go to the U.S. Treasury. Fortunately, we could just type that into Google. You pull it up, U.S. Department of Treasury website, view the daily par yield for the rates or the daily yield curve, and you can see what U.S. Treasury bonds pay. And in this case, an inversion means a shorter duration bond pays more than a similar longer dated bond. So in this case, the 2-year U.S. Treasury, keep in mind, this is as of April 1st, no April Fool's joke. So as of Friday, the 2-year Treasury, so it matures in 2 years, pays 2.44%, which is more than what you can get with a 10-year bond, which is 2.38%, which normally you might say, well, wait a second, does that make any sense? Because I'm taking on more risk to hold this for 10 years. Shouldn't I be compensated more? And we'll talk about that dynamic, in this video. And this is what the yield curve looks like now. And normally it just keeps on sloping up. And that's ideally the sign you want to see. And you can see 1 month, 2 month. You can see this is the various different time frames up to 10 years, 20 years, 30 years. And you can see that this curve gets inverted not once, but twice, once between the two, let's say 3-year and the 10-year, and between the 20-year and the 30-year. This is not a sign of a healthy yield curve and healthy financial expectations. So how come there's this correlation or there's this tie between a bond market flashing a recessionary signal? Why is this potentially a recessionary signal? And well, let's look at the data. And this is from the Federal Reserve, where they talk about various different yield curves inverting. So that means, the 2-year, let's say the blue line is the 2-year versus the 10-year. And this is an example. So every time it dips below this line, this means that 2-year yields more than the 10-year. Whenever it dipped, oftentimes it preceded a recession. A recession you could see in these gray bars, and it might be a couple of quarters, but you can see it often happened. And you could also look at the near-term forward spread, which is another type of inversion, comparing very short-term bonds versus, let's say, 6 to 8 quarters out, where that was an even better indicator, saying, hey, that when that inverted, then you very likely had a recession in the coming, quarters or coming months. And so that, either way, you look at this over several decades, and it typically precedes a recession, which obviously could be a stark warning for investors. Now, why have you seen this correlation happen? And, there is this concern, wait a second, correlation is not causation. Just because it happened doesn't mean it caused it, or what's going on here. So let's pause to understand why bond investors might be betting on this outcome. Why are they, these bond investors actively inverting the yield curve? So first, it's worthwhile to understand that unlike with stocks, where you can hold them forever, when you're dealing with bonds mature. So that 2-year bond, that's going to mature in 2 years, and bondholders then face this reinvestment risk. Reinvestment risk. What's that? So this is where the yield you invested at is no longer available, and only, let's say, much lower yields are available. Now, why might this happen? If you go back to prior recessions, what does the Federal Reserve do? They lower rates, often to zero, to try to jumpstart the economy. So investing in a lower yielding 10-year bond might actually have a better return than investing in a 2-year bond, which has a higher return, let's say, for the next 2 years, because in that time period, you might have a recession, let's say, in the next 2+ years, and that 2-year bondholder might then be stuck with rates much closer to zero as the Federal Reserve is forced to respond to this. So that's effectively what the bond market is betting on, where all these investors are saying, hey, I'm comfortable getting a lower yield on the 10-year because I'm not so sure I'm going to be able to reinvest this 2-year, 3-year bond at a similar or better rate in 2 to 3 years when these bonds mature. Now keep in mind, this isn't some willy-nilly bet. This is a huge big and deliberate bet. The value of U.S. government debt is tens of trillions of dollars. This is a huge bet that's going on, and it's not just one player. This represents the aggregate. This represents the market saying, hey, the market is concerned. So this isn't some sort of spurious correlation between inverted yield curves and recession. There's a real dynamic here, a very real deliberate bet by trillions of dollars worth of bondholders. And keep in mind, this is many, many, many different bondholders saying, I'm worried about the U.S. economy over some sort of time frame. When you have the 2 to 10 year frame, inversion, that might mean it's 2 to 3 years out. A shorter term inversion might be more, might happen more in the short term. So how should investors consider investing if you are facing this oncoming potential recession? I'm not saying, hey, I'm a strong believer in this. I'm saying, hey, this is the data points. I personally do, think that, seeing these data points does suggest the risk is increasing. So with this bond signal of economic turbulence, how should you consider investing? There's a lot of different ways. First, a quick plug where if you're interested in finding new investments for both good and bad times, or you'd like to follow along with my personal financial journey, go to unrivaledinvesting.com, where I write a weekly letter. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. And so, first of all, as I already alluded to, there are some academics at the Federal Reserve that think the 2-year, 10-year inversion, where you're getting a higher yield on the 2-year versus the 10-year, they think it's not a big deal, and that we should only focus on an inversion if it happens in the shorter dated curve, comparing, let's say, a 1-month rate versus a 2-year rate. If all of a sudden you're getting much higher rates on the 1 month versus the 2-year, then they'd say then a recession would be imminent. They might have a point here about the inversion of that shorter, the near-term forward spread. That's the red line here, being a even better indicator than the 2 and 10-year spread. Personally, I think this debate is semantic in nature because the 2 to 10-year spread preceded the inversion of the near-term spread in several cases. So I'd argue the 2 to 10-year spread is probably a better leading indicator versus the near-term forward spread. That's what I'd argue. You're starting to get a little bit too much in the weeds here. This is clearly a sign by billions, trillions of dollars of bondholders saying, hey, there's stuff to be concerned about. So how am I, considering this? And let me share this. Unrivaled Investing is for the details of the companies I look at, and I call out new ideas each week. But from my high level, what do I think investors should consider? And keep in mind, this is not, there's no advice here. This is an educational channel. What I'm thinking about here is that when you consider the heightened risk of a recession and the data points from an inversion from this bond market, this $30 trillion bond market, plus saying, hey, you should be mindful of this, I think there are a couple of key points investors need to consider. One is that the upside-downside perspective does become a little more skewed to saying, hey, maybe a little less risk, maybe having some more capital available to deploy should a recession happen. Because generally, when recessions happen, you see economic contraction, so earnings contract, and you also see as earnings come down, it's not like people just act completely, Borg-like, where they're saying, this is an economic recession, the earnings will pick up. No, you get a double whammy with a lot of stocks where earnings go down, then the valuation goes down as well, and so the stocks really get hammered. And so that's, an aspect to consider is that maybe considering having some capital available. I talk about this regularly with the Unrivaled Investing Journey subscribers. And so that's a one component to consider is, am I prepared potentially for a recession and what it could mean for the opportunities available? Because in a recession, I'd argue the opportunities are just mind-blowing about what can be available. The other aspect is to be mindful of the valuations. When times are really good, it's very easy to get caught up with everyone else and say, hey, 20 times sales sounds great. So I think to be mindful of the price that you're paying and what price you would want to make a company a full position. What price you'd say, okay, this is the price that I'd say, oh, this I'm making a 5% bet. I'm making a 10, 20% bet. And having that in mind, because with a recession potential risk, you never know what prices you're going to get. You never know what sort of limit order is going to get filled. And I think a third key component that I'd leave for you in this video is for each company you're looking at, think about the robustness or the fragility of the business, because you want to be thinking about, hey, does this business have what it takes to survive, thrive, potentially even grow through economic hardship. And that means, if you have a company that's, let's say, a subprime lender that has an extremely leveraged balance sheet, so they are loaning to questionable credits, and they may or may not get paid back in an economic downturn, and they borrow a lot of money. That type of business model is more at risk, and that's what you saw with the great financial crisis. So you have, that company is more fragile, I'd argue, versus a company, let's say, like an insurance company, where unless there's a series of catastrophes, that business should probably be steady each year, maybe even grow with a little bit of inflation. And then you see how are they positioning themselves? Are they holding a lot of cash? Are they prepared for potential economic recession? So then you see a business that holds lots of cash, and you go, wow, I'm investing with a business that might be able to take advantage of an economic downturn. They might be able to have lots of capital to deploy, and you've seen that certainly with Warren Buffett's Berkshire Hathaway. Now, he's not trying to time the market. I'm not trying to suggest you do that either. What I'm trying to say is, that's why my first point was talk about capital available. Second point was valuation. So if things get cheap, that's when you start swinging. And so things generally do get really cheap when that last piece falls in, which is you have that economic contraction. So I hope this video talking about the inverted yield curve, what it means, why it happens, and why it has historically preceded recessions. I hope this has been valuable for you. If it has been, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.